Hi friends, welcome to the second video of economic lecture series. I'm Dr. Arjun Bopanna of Bangalore IAS Academy. This video is brought to you by Mentors for IAS and Namak APSC. So in the previous video, we started with fiscal policy, the chapter on fiscal policy. So in the previous chapter video, I discussed what all topics that we'll be covering in this fiscal policy chapter. We defined what is fiscal policy, what is its impact. Then we discussed the objective of fiscal policy. Then we discussed the types of fiscal policy, that is neutral, expansionary and contractionary fiscal policy. Then we started to understand the terms that will be discussed in the chapter, that is receipts, expenditure, what is revenue receipt, what is revenue expenditure, capital receipts. So those who have not watched that video, please watch it. Otherwise, this video you will not be able to understand. So we classified the revenue receipt, revenue expenditure, capital and revenue receipts on the basis of asset and liability. So having thinking that you would have watched that video, we'll move on to our further discussion. Now, next topic is classification of our budget. Now, when the government presents its budget, the budget will be divided into two broad headings. One is the receipt and the other one is the expenditure. So when we say receipt, as discussed in the previous video, anything that the government receives into its account is receipt, and anything that the government spends from its account is expenditure. Now, the receipts can be further classified into two types, as discussed yesterday. That is your revenue receipt and your capital receipt. So what is revenue receipt? Revenue receipt is any receipt, any money that the government receives that does not increase the liability of the government, or it does not reduce the asset of the government. Such receipt is known as revenue receipt. And capital receipt is anything which increases liability or reduces the asset of the government. Now let's try to further classify them. Revenue receipt is further classified into tax and non-tax. Tax revenue receipt and non-tax revenue receipts. So taxes are of two types: direct tax and indirect tax. Example of direct tax is income tax, and example of indirect tax is GST. So we will discuss this, we'll keep this for later. What is direct and indirect, how it is differentiated, we'll keep it for later. For now, you understand that tax is a type of revenue receipt. Why? Because tax does not increase the liability of the government. That means the government does not have to give it back to somebody, nor it reduces the asset of the government. Okay, so that's why it's a revenue receipt. Next, you have non-tax revenue receipts. Any other revenue receipt other than the taxes, okay, are called as non-tax. So what are they? So they can include profits. The government will make profits from various investments. Like government would have invested in factories, government would have invested in businesses, government will have property which it has given for rent. So all this profit that it gets, okay, is non-tax revenue. Similarly, the toll, the tickets, okay, and the earnings that it gets from the services that it provides, like postal service or banking service or irrigation service, electricity, etc. Money earned by them, BSNL, BESCOM, anything, any kind of public distribution system, etc. They earn money from that. Okay, so the profit, whether they make profit, that's a different matter. If they are making profit, like Air India, let's say, Air India makes profit. If it makes profit, that becomes non-tax revenue receipt, because the profit, the government does not have to repay it to anybody, nor is it reducing the assets. So profits, toll, tickets, services, etc. Okay. Then another important source is grants. The government receiving grants from any source. Like for example, a foreign country can give government of India certain grants. What are grants? Grant is any money that the government does not have to give it back. Okay, it's like a gift. So grants therefore does not increase liability, nor it reduces the asset. So therefore grant is also a revenue receipt. I hope it is clear. So profits, toll, tickets, fine also, the fine that you pay when you break traffic rules, etc. So that also is revenue receipts. Okay. Then government would have given loans. So the interest, it would have given loan to, let's say, the state government. So the interest earnings from the loan the government has given is also revenue receipts. Okay, so all other than taxes, non-tax revenue receipts. Is that okay? So this is your revenue receipt. It should not increase liability nor reduce the asset. Next is capital. What is capital receipts? Anything which increases the liability of the government or which reduces the asset of the government. So this can be further be classified into debt creating capital receipts or non-debt creating capital receipt. Debt creating means that which increases the liability, that is borrowings. When government borrows money from any source, whether it is from the public, whether it is from the financial institutions or from any other outside country also, so that is debt creating capital. Why? Because it is increasing liability. And non-debt is, example is disinvestments or privatization. So this is non-debt creating capital, because here this reduces the asset. Similarly, recovery of loan. When the government of India would have given loan to state government, the state government repay backs the loan. So that loan is, the loan recovered is capital receipt. Why loan recovery is capital receipt? Because the loan was an asset. Why was it an asset? Because the government was earning interest from it. Now when they have recovered back the loan, they will not receive the interest any longer. So it is not an asset anymore. So the asset is reduced. So therefore it is a capital receipt. So this classification is solely alone on the basis of liability and asset. Okay. Then usually revenue receipts are recurring. Okay, it is recurring. That means it is continuous on a regular basis, recurring, or it is regular. Like for example, taxes, it is recurring. Okay, the government keeps collecting taxes every day, every year, like that. Whereas disinvestment is not recurring. Is it recurring? No, it is once in a while. Okay, so once you have disinvested, you can't keep disinvesting the same asset. See, once the government sells away Air India, okay, it is disinvestment. It cannot keep disinvesting the same thing again and again, right? Whereas taxes, it will keep collecting. Profits, it will keep getting. Tolls, it will keep getting. Interest, it will keep getting. So therefore, revenue receipts are usually recurring. Whereas capital is not recurring. I hope this is clear. This is how we classify the receipt part of the budget. So receipt, revenue receipt and capital. Revenue, tax and non-tax. Tax, you have direct tax and indirect tax. Okay, capital, debt creating and non-debt creating capital receipt. Okay. Next is your expenditures. So expenditures, okay, are also classified into two. That is revenue expenditure and capital expenditure. So what is revenue expenditure? Yesterday I told you revenue expenditure is any expenditure that does not reduce liability or it does not increase asset. Anything which does not reduce the liability or increase the asset is known as your revenue expenditure. Capital expenditure is anything which increases the asset or which reduces the liability. So let's see revenue expenditure is something wasteful expenditure which does not create any asset nor it will reduce your liability. Like for example, salaries or subsidies that the government gives, or maintenance. See, when the government gives salary, is it creating asset? No. Is it reducing the government's liability like outstanding loan? No. Similarly, if the government gives subsidy, does it reduce liability? No. Does it increase asset? No. Similarly, maintenance cost, law and order, money spent on paying salaries, etc., on or even for army, okay, military, etc., or paying interest for the loans that the government has taken. So does that create any asset? No, the interest payment does not create any asset. So therefore it is also revenue expenditure. Next is capital expenditure. So what is capital expenditure? It increases asset or reduce liability. Let's see the asset part. So if the government spends money on building a factory or building infrastructure or buying an equipment All this is creating asset. Or when the government repay back the loans it has taken, it has reduced the liability. So therefore it is capital expenditure. This is how we classify the budget. So we have 4 headings now: revenue receipt, capital receipts, revenue expenditure, and capital expenditure. I hope this is clear. Now you can pause this video and read the definition of this. Okay, I'll move on. So as I told you, revenue expenditure, capital expenditure examples, you can pause this video and read it once again. Now if you see the budget, this year's budget, 2020 budget, there is a breakdown of a graphical representation of government's expenditure and government's receipt. So that means where does a rupee come from? That is receipt. And where does a rupee go? So if you take 1 rupee, what the government is receiving, so out of that, if you see here, this is a breakdown. So where all the money comes from? So 20% is coming from borrowing, 10% is coming from non-tax revenue, 4% from customs, 18% from GST, 18% from corporate tax, 7% from union excise duty, 17% from income tax, and 6% non-debt capital receipt. Now if you see which is the largest share in terms of receipt, so borrowings. The government borrows 20% of the money it receives. So if you say government has 100 rupees, 20 rupees is borrowed. So in terms of revenue receipt, which is the highest? Corporate tax and GST. If you see here, corporate tax is 18%, GST also is 18%. Okay, then if you take personal income tax, 17%. Okay, so first is GST and corporate tax. These kind of questions can be asked. Which is the highest, in terms of percentage, which is the largest share in government's receipt? So largest share is actually borrowing, followed by taxes, your direct and indirect taxes. Now coming to the expenditure, if you see what all the government spends. Okay, so if you see the expenditure, the maximum expenditure goes, okay, if you see here, state share in the taxes. So government gives 20% of the money that it has collected to the states. Okay, then you have interest payment 18%, defense 8%, subsidy 6%, centrally sponsored scheme, pensions, other expenditure, central sector schemes, finance commission transfers 10% like this. So this data would be important because they can ask in your prelims examination. Okay, so you can pause this video and you can just make a mental map of the same. Okay, now we will try to solve some questions related to what we have discussed. I hope this is clear. Now so here's the question. You can pause it, answer, and then we will discuss it. Okay, so which of the following comes under revenue expenditure? So expenditure is anything that the government spends. What is revenue? I told you revenue is something which does not increase, okay, the assets, or it should not reduce the liability of the government. Government spending this money does not create any asset or reduce the liability. So let's see what it is. So purchase of new fighter plane. Purchasing a fighter plane is actually creating an asset which it can sell it later on. Okay, so this is not revenue expenditure, it is capital expenditure. Okay, now this is wrong. So you can rule out these two options because it is the next subsidies. So subsidy is not creating any asset or liability. So it is a revenue expenditure. So which one you can rule out? You can rule out this. So you already got your answer, that is option A. Anyways, we will discuss the other sentences also. Salaries obviously is a revenue expenditure because not creating any asset nor reducing liability. Repayment of public loan, that means if government pays back the loan it has taken, it has reduced the liability. So therefore it is capital expenditure and not revenue expenditure. Then buying of shares. Buying of shares will do what? It is increasing the asset of the government. So therefore this is also not revenue, it is capital expenditure. So we have confirmed our answer, that is A, 2 and 3. Next question. Which of the following is included in the capital budget? So here they are not asking whether it is revenue or, they are not asking you whether it is income or expenditure. So capital receipt, or it can be capital expenditure. So which of them is included in the capital budget? So expenditure on acquisition of asset. Okay, so when you are creating asset, it is creating it is capital expenditure. Then loans received from the foreign government. So this is also a receipt, okay, but it is capital receipt. So this is also correct. Okay, so you can rule out this option, you can rule out this option. Next, loan and advances granted to the state. So this is capital expenditure. Okay, so this is also correct. So the answer is D, 1, 2 and 3. Okay, so that is the answer. Now, so this is how we classify our budget. So again discussing budget, receipt, revenue receipt, tax. Budget, receipts, okay, revenue, non-tax. Budget, receipts, capital, etc. So first we will go and start our discussion with taxes. So receipts may you have revenue and capital. Revenue may you have taxes. So we will start now our discussion on taxes. I hope this is clear. Okay. Now taxes, that is the tax policy of India. Okay, so you must all be aware as to what is taxes. Okay, now for those who do not know what is tax, so tax is derived from the Latin word taxo. Okay, so what is it? It is a compulsory financial charge or some other type of levy that is imposed on an individual or a legal entity by the government organization in order to fund various public expenditure. So what is it? It is a financial charge, okay, or some type of levy that is levied on individuals, or it can be any other legal entity like a company. Okay, legal entity like a company. Okay, by whom? By the government. By the government. For what? In order to fund public expenditure. Okay, like roads, buildings, etc. So these are nothing but financial charges levied on individuals or any legal entity by the government in order to fund public expenditures, right? So these are compulsory. Okay, you don't, it's not voluntary that, oh, you come and donate. No, it is compulsory. Okay, so now we will discuss some aspects of taxes. Okay, classify them, etc. And tomorrow or in the next video, we will be discussing about direct taxes. So having understood what is tax, tax structure can be classified into 3 types: progressive taxes, regressive taxes, and proportional taxes. Now let's try to understand what these are. Progressive taxes is when the tax rate increases as the value or volume increases. If the tax rate increases when the value or volume increases, is known as progressive taxes. Okay, it is known as progressive taxes. So what is this progressive tax example? You have your income tax. If you take your income tax, so as your income increases, as the income increases, the tax that you have to pay also increases. This is an example of progressive taxes. Here is an if you see here, this is an example. So up to 2.5 you don't have to pay tax. This is last year's. Okay, up 2.5 to 5 lakh you have to pay 5%. Okay, then 5 lakh to 10 lakh you have to pay 20%. Above 10 lakh you have to pay 30%. So as the value increases, you have to pay more tax. So therefore, it is an example of progressive taxation. Okay. Next, so progressive taxation helps to reduce inequality. Okay, so rich pays more, poor pays less. So this will help to reduce inequality. That is the main objective, okay, of this particular type of taxes. It is based on the ability to pay. So you can pay more tax, you have to pay more tax. Okay. So that is the idea. This is one of the most common method of taxation. Most common method of taxation. The advantage is it reduces inequality. But what is the problem of this particular type of tax? So the more the income, okay, the more tax you have to pay. So this discourages people from disclosing their income. This leads to tax evasion. So now if I have to if I earn more money, I will be paying more tax. So what will I try to do? I will try to show less income, or I will try to hide my real income. This may lead to tax evasion. So that is the problem of this particular type of tax. Progressive taxation is subjected to tax evasion. Next is regressive tax. This is opposite of progressive tax. That means here the tax rate decreases with increase in value or volume. That means when you, if for example, take the example, if you earn more, you will have to pay less tax. This is very, it is not a very common type of tax. It's not a very common type of tax because it increases income inequality. Rich will be taxed less and poor will be taxed more. So therefore, it is not commonly used by any democratic country, okay, because it will lead to, it goes against the principle of welfare. So usually it is used temporarily in order to promote a particular sector. Let's say small scale industry, it wants to promote small scale industry. So it will say you produce more, you pay less tax. So it motivates them to produce more. Okay, so that you produce more, you will have to pay less tax. Okay, but this is usually used as a permanent approach. It is not going to be a permanent approach. Okay, so that is regressive taxation. Next one is proportional taxes. Proportional taxes is irrespective of value or volume. Okay, the tax rate remains the same for all. Tax rate remains the same for all people is known as your proportional taxes. An example is, let's say, GST. So GST, if you are a rich person, you say Ambani also will have to pay 10% GST when he buys something. Even a poor person has to pay 10% GST. Let's say toothpaste. Toothpaste is charged at 10% GST. Now let's assume. So when Ambani buys this toothpaste, he pays 10%. When a poor man on the street buys this toothpaste also, he pays 10% GST. So irrespective of value or volume, okay, the tax remains the same. This is proportional taxes. Example is your GST. Okay, so this is an example of progressive and regressive taxation. Okay, I hope this is clear. Now if you so this is the income tax this year's slabs. So up to 2.5 they don't have to pay any tax. 2.5 lakh earning per annum, they don't have to pay any tax, they are exempted. 2.5 to 5 lakh they have to pay 5% tax. 5 to 7.5 lakh earnings per annum, 10% tax. 7.5 to 10 lakh, 15%. 10 lakh to 12.5 lakh, 20%. 12.5 to 15 lakh, 25%. And above 15 lakh, they have to pay 30% tax. So as your income increases, you have to pay more tax. So this kind of tax structure is known as progressive taxes. So having understood this progressive taxes, now let's try to understand the feature of India's tax, income tax at least. So here, majority of Indians are not liable to pay income tax in India. Almost 93% of Indians don't pay income tax because their annual income is less than 2.5%. So that means India has a very narrow tax base in terms of income tax. Then you have several categories of income earners like farmers. They don't have to pay tax. How much ever they earn, they don't have to pay income tax. Then a large section of people earn their money, okay, through cash. Okay, they are non-salary income and they earn in cash, like consultants, professors, professionals like doctors, lawyers. Okay, they earn in cash. So therefore, they tend to not disclose their real income. They may end up paying no tax. So this is the feature of India's income tax. Just to give you an idea, see, these kind of infographics will be there in your newspaper. Now you should be able to appreciate them and relate them with our discussion. Okay. Now coming to the, we'll discuss this all later. Coming to the different types of taxes. One way of classifying taxes is direct tax and indirect taxes. Okay, what is this direct tax? What is this indirect tax? Let's try to understand. Direct tax is where the tax is levied on an individual and is collected from the same individual is known as direct tax. That means when the tax burden cannot be shifted is known as direct taxes. When the tax burden can be shifted, it is levied on a person but it is shifted to somebody else is known as indirect tax. Now let's try to take an example. Income tax. I've been telling that income tax is a direct tax. Why is it a direct tax? Because tax is levied on individual and the same individual has to pay the tax. You cannot shift the burden. If you are earning money, you have to pay tax. Therefore, it is direct tax. Whereas example of indirect tax is GST. Now let's say a manufacturer of a toothpaste, So government levies GST on the manufacturer of toothpaste. But what does he do? He will transfer that tax to the consumer. So he will include that GST in the product. So you might have seen in the package saying that inclusive of all taxes. Now if you are paying 50 rupees for the toothpaste, it says inclusive of taxes. That means the actual commodity might be say 35 rupees. The tax will be 15 rupees. So the total cost will be 50 rupees. So 15 rupees is the tax which actually will be collected from the manufacturer, but he will transfer that burden to the consumer. So that is indirect taxes. Example, GST. Now, which one do you think is therefore better tax? Is direct tax better or indirect tax better? So the answer is direct tax is a better tax. In terms of welfare, if you take into consideration, direct tax is better, because direct tax is a progressive tax. That means it's based on the ability to pay. So your income increases, you pay more tax. Whereas indirect taxes, now GST, irrespective of whether you're rich or poor, you have to pay GST. So even a poor will be paying the same amount of GST as a rich person. So therefore it is not a good type of tax. So our attempt is to reduce the burden of indirect tax and increase the direct tax. So that is what even the government is doing. GST, for example, is a reform introduced by the government in order to reduce the burden of indirect tax. Overall burden has come down. Similarly, we are trying to bring about various reforms in direct taxes, okay, like making Aadhaar linked with PAN compulsory, mandatory, etc. All this will increase transparency, and therefore you have to pay more direct taxes. Another way of classifying taxes is state tax and central taxes. So what is state? I mean, because India is a federal country, so federal state setup. So there are some taxes which are levied by the state and collected by the state. There are some taxes which are collected by the center, levied and collected by the center. Like for example, income tax. Income tax is levied by the center and it is collected by the center. Now for example, GST. GST is levied both by the center as well as the state. Okay, if you take for example your professional tax. Professional tax is levied by the state and collected by the state. So we'll come to that discussion later. Now we will finish off direct tax and indirect tax. So here is an example. Here is table explaining the difference between direct tax and indirect tax. Okay. So direct tax, as I already discussed, a tax is said to be direct when the impact and the incidence of the tax is on the same person. Whereas indirect tax is when the tax is on one person, but the incident, that means it is levied on one person, but the incidence of it is on another person, is known as indirect taxes. Here, burden is on the same individual. It cannot be shifted. Whereas indirect taxes, it allows the tax burden to be shifted. Next, viability of payment. Direct tax is less burden on people who cannot pay tax. It is based on income earnings and the ability of people to pay. So you can pay tax, you pay tax. If you are a poor person, you are earning less than 2.5 lakh, you don't have to pay tax. So it is based on the ability. Whereas indirect tax, okay, it is not based on ability, it includes every individual. Okay, it is borne by the consumer of the commodity or services, irrespective of their financial ability. Now, administrative convenience, which is easier, okay, which is easier for the government to collect. Okay, here indirect tax is easier for the government to collect. Why? Because it is incorporated in the product itself. It is in the part of the product. If you, as I told you, your toothpaste, okay, the toothpaste, you paying 50 rupees. In that only there is tax, 15 rupees tax in our example. So the tax is already a part of the purchase. You don't have to go and pay tax separately, or the government does not have to collect it from every individual because it is already part of the product. So the cost is very less. Whereas direct taxes, you have to declare your income. If you start hiding your income, the government will not be able to collect that revenue. The administrative cost is more. If improperly administered, there will be tax evasion. You will show less income and you will pay less tax. So administratively, which is good? Indirect tax. But in terms of welfare, which is good? Direct tax. Indirect tax is not welfare oriented because it does not discriminate between rich and poor. Okay. So this is what it is. So now if you take examples of direct and indirect taxes. So as I told you, GST. Earlier, before GST, we had central excise, we had central sales tax, we had service tax, we had octroi, value added tax. All that I will be discussing in the next videos. Direct tax include your income tax, corporate tax, property tax, inherent tax, gift, wealth tax. All these I will discuss in the next video. So this is the classification of direct and indirect taxes. Okay. Similarly, as I told you, the taxes are divided between state and central government. So state tax, as I told you, income tax, excise duty, service tax, customs. Now this excise duty and service tax is part of GST. Custom is outside GST. Next, you have state government, you had sales tax, VAT, entertainment, toll tax. All these are now part of GST. Then you have professional tax, stamp tax duty, luxury tax, octroi, capital gain tax. All these are part of state government. Okay, so capital gain tax, is part of central government. Next, you have local government. Sometimes property tax you will have to pay to the local government. The state would have transferred this power to the local government. Okay, so property tax can be part of the local government. This is based on the jurisdiction. Okay, so the classification can be either direct or indirect tax, or it can be central tax and state tax. In central tax, the GST and all is your indirect taxes. Your income tax is a direct tax. Okay, so this is how we classify the taxes. So in the next video, we will start with direct tax. We will discuss the different types of direct tax, and we will discuss the reforms in direct tax, that is your direct tax code. And after that, we will start with indirect taxes. We will discuss the different types of indirect taxes, and then we will discuss about GST. I hope this particular video was useful. Continue reading the chapter and going along with the video. Okay, read current affairs, etc. Okay, if you are happy with the video, please like the video and give your comments in the comment section. If you have any doubt, feel free to write in the comment section. Thank you. Have a good day.